Hello, hello. Hi, everyone. Let's make sure you guys can hear me. All right. Uh, Good afternoon, Rameshi. One second, let me. All right, there's some changes on the Zoom content that happened. I just want to make sure that that hasn't disabled some of the stuff that we used to have it enabled in the previous meeting. So I think everything should be okay. So you guys can hear me and you can see the document. Uh, Anything unusual, or is everything look
Yeah,
okay?
we can hear.
Okay, cool. So I didn't mess up any stuff. I just wanted to check that. All right. So, I'm back in States, and now I'm back at my usual place. Uh, Sorry for last 3, 4 weeks. I've been traveling, and I know we couldn't have the meeting the way we've been doing for almost 5 years. So and I appreciate you guys dealing with me while I was just trying to manage the family situation. So good to be back, and probably we'll be able to maintain our regular schedule on meeting every Saturday. So while I was gone, or I would say not entirely gone, maybe I was little not watching the markets very closely. I actually got back into the market this week. So what else you guys did? Anything new? Anything fun? Uh,
Go long.
Sorry, what was that?
So I went long.
Uh,
Opened up a bunch of long positions.
oh, long positions. Yeah. And I think that would have worked out really well because markets hit new all-time highs now, right? All
Yeah,
long.
exactly. Yep.
Yeah. Thank you, Jose, for welcoming me back. Let's,
Vivek,
yeah.
can you talk about later on the AI boom? I mean, the best one I heard was at least these companies are earning money, unlike 26 years
So,
ago.
so, so today, one of the
Later on.
yeah, today, I mean, that's the main agenda for today is, apart from our usual macro and all that stuff, today I want to talk about is AI a bubble that's about to burst, or what is it? So I think that exactly falls into what you are asking for, because I've been also reading a lot of chatter even in the newspapers, in the magazines, on the Twitter, etc. A lot of investors drawing the similarity between the dot-com and what's happening in currently on the AI front. So I do want to take you guys through um, all information so that you can make your own judgment and see, and decide what you want to do with the markets, right? Uh, uh, and I think so far we've been talking about it. Even if we say that AI is growing, investments are growing, and the market valuations are growing, right? But we had this um, similar stuff in dot-com where the valuation started growing in 1995 itself, right? But then it grew all the way to 1999 before the bubble actually burst, right? So even if we get out early, that's not going to be good. And I don't even I can't just time the market. So I will present some numbers, some figures for you guys to decide on what do you think about AI and how you want to play with it. That
So
is definitely.
Vivek, I posted a video in the chat about AI bubble, and I think it kind of lines up what I think. I think we are in easy money times right now, right? So I think as long as that continues, and we're probably gonna take a break, but it'll continue next year when they have a new Fed chair. As long as that happens, AI can keep going because all the crap stocks are going up too. Like the risk on is trade is on right now, and AI, even if it's not, you know what I mean? Like, So I think if they start raising rates again, then the A bubble could pop.
Yeah. No, so yeah, so we will talk about it. I mean, in a macro, I'll cover about what are the tailwinds, but specifically on AI, I have a lot more information. There is a report from Kotu. Where is Aditya? That's like his favorite fund manager out from UK. So I don't see him yet. So they also had their own report out, their October report. A lot of good information in that. So I'll cover that stuff. Sam, can you talk about how overpriced cost of living is in San Francisco Bay Area compared to even as a visitor to India? I mean, visiting in India, if India and San Francisco Bay Area is not even comparable. If I go back to India, I can retire. Let me put it very clearly. And I don't even have to take any risk in the stock market to retire. I can, if I sell all my, everything out what I have out here and move back with my family in India, I can just put the money in fixed deposits or CDs. In India, they call it FDs, and I can just live on the interest. So it's from a
Uh,
price perspective, it's a very, very
Vivek, what
cheap.
I wanted was the cost.
Yeah.
Like Hong Kong, November 2020 was 80% of San Mateo, and since San Mateo has got up over twice, so the cost.
So real estate, I mean, it's not even comparable. So let me put it that way. So I actually had because I wanted to go and see a dentist while I was in India. So I went there. I saw the dentist. He took an X-ray. He also did oral examination and everything else. And it was a pretty decent clinic, right? They probably had me put on a hair wig. They had me remove my shoes and wear the slippers which they provide. And it was a lot more cleaner than what are the some of the dental offices that I visit in Bay Area. And you know what it charged me? Including X-ray and probably spending 20 minutes to look at it and then give me his opinion. He charged me like 500 rupees, which is what, $6, $7. So it's just not even comparable. Right, but that's like a Starbucks coffee. I had a dental appointment at the rate of a Starbucks coffee. And that was at a dental office, which is probably at a higher rate than usual, you can find in other places. So so cost of living is not even comparable. It's way cheaper. But then you have we have our own advantages in Bay Area, which is different. Dave, dual citizenship? No, India does not allow dual citizenship, so I have to take a visa. Or there is another process which I have not yet done. So in which you don't need a visa, you get classified as overseas citizen of India, but you need to go through that process. Jose, AI bubble will not pop. Okay, yeah, we're gonna talk about that. What else before we jump into our regular discussion? Anything else on your mind? How gold, Iran. Yeah, these all neo clouds have been running. When I say I want to talk about gold, there is nothing much to talk about gold, right? Because it doesn't produce anything. It's all based on what we as an investor worry about the overall geopolitical situation. So gold has always been a hedge around government mismanagement of money, and then we see, whenever we are scared about the economy. Other than that, um, it you cannot value gold. You can only price gold, right? And gold, the performance of gold over the last 2 years have been nothing but spectacular. I mean, we haven't ever seen gold performing so strongly versus S&P 500. Right? What it has done over the last 2 years. But let's also remember that gold also had its um, decade of no performance, right? So I am not, especially at this price point, I am not going long on gold. Whatever I have, I'm not selling it, but I'm not going long on gold just yet. And of course, we have seen over the last 2 years, a lot of these prices in gold or the demand of gold was coming from the central banks, and because they've been accumulating gold, selling treasuries, and basically getting gold onto their reserves. So there was a report, I think, before I was traveling, I had shared some numbers in which what the gold became the number one, the top asset on central bank's balance sheet, um, as a reserve asset than US treasuries. Because other countries do want to insulate themselves from the vagaries of US dollar, especially based on what US government has been, how the US government has been performing over last 2 3 years. And so they do want to make sure that their future is not 100% tied to US. Jose, gold going sideways. Yeah, if it stays on sideways, it'll be great way to sell some option premium on gold, because even I think the option premium are still decent, right? Going out for December, which is 55 days out. I mean, you can get some decent premium still on gold. Gold being a commodity, if the price goes higher, the vol goes higher in it. So which is unlike in a stocks. Commodities and stocks work different way. If a stocks fall down, you will see the vol increasing, but on a commodities, the vol increases when the price of the commodities go high, because the risk is on the upside when it comes to commodities. So, I mean, if you want to sell some premium on it, you still have a pretty decent premium, right? Going out for 30 delta, you can get over $6, almost 2.5% for what, 55 days? Not bad. Morning, Aditya. So I was talking about code 2, and then I remembered you. So good to see you back. RJ, hi everyone new in the group. Yeah, I'll probably ask them. Anyone else who's new? Who are the folks joining for the first time? I see RJ, Corey, Cosmos. Anyone else who is joining it for the first time? Oh, Rowell.
I am Van Tay Terrell Smith Johnson. I'm joining for the first time.
Hey, all right, thank you. So where are you guys joining from? Just put in the chat, well, which place you're joining from. I just want to see what's the geographical spread. I'm in Bay Area, but I know a lot of folks are from Michigan or East Coast or San Francisco, Vancouver. Sherwin, you can't be new. I've seen you before here. Uh, Varsha is joining from first time. From where are you joining, Varsha? Uh, right, RJ from Austin, Texas, Vancouver, Washington, San Jose. Oh, that's in a neighborhood. Phoenix, Arizona, Michigan. Also, this is Michigan uh, gang. Terrell says Phoenix. Vivek is from Bay Area. All right. So we have two. Jay, I know you. Jay is from Saratoga. Mega is from Mountain House, California. I know Satish used to join. I don't know if it's a Satish is behind this Mega Satish, or is it's a different one from
Yeah,
so
you're right.
that's
I just logged in with my wife's laptop.
okay. So that's what I was guessing. I like Mountain House, and I know Satish joins from Mountain House, so maybe you have a different ID. The name is different on Zoom. Sandarsh is from Bay Area, Aditya LA, Nyanka Bay Area. Cool. So a lot folks in Bay Area as well. All right. So for those who are joining new, maybe we could have a time for a couple of introductions. Who wants to go first? We have a few new folks. So my idea is just tell who you are and why you are interested in this group. Okay, so ours is gonna log off. Let me see. Vineet. Vineet mentioned he's new.
Hey, Vivek, Vineet here. We used to work 10 years back when you were at Hortonworks and I was at Pivotal. But
Ah, okay, got it. You
yeah,
moved to
long
East
time
Bay,
no see.
right? Or did you move to East? No,
No, no, no.
no. I
I'm
think
been
it's
in the
a
Bay
different.
Area. But yeah,
Yeah,
first time joining, very interested in investing and I sort of take a long-term approach to investing. So just want to learn and I have never done options or trading and I'm not sure if like I want to explore it. So yeah, I just want to learn from this group and see how you guys are doing.
cool. Yeah, so from my focus is always long term. I just use options as a stepping stone to keep me in the market for long and just survive in the market. But if I take any positions, my generally time horizon is forever, unless the business starts to underperform and give me a reason to sell it. But options give a flexibility to own it at a lower than the market price. You can manage your risk, you can hedge your positions and all that. I don't use options to
Good,
buy the
good.
lottery tickets and hit it out of the park. That's not my way of using.
Perfect. Thank you.
Cool. Who else wanna go? Corey, wanna introduce yourself? And
Can you hear me?
yeah, I can hear you.
Yeah, my name is Corey from Miami. I'm in the San Jose area now, and I'm interested because I opened up a Roth a few years ago,
Mhm.
and I started investing long term. And I feel like I'm playing it very safe right now because I don't really know any other way to play it. I'm a real estate investor, so usually I stick to real estate, and I decided to use the Roth to venture here. And yeah, so right now I have some holdings with S&P index funds, VOO.
Mhm.
I've got some gold holdings. It's not the one that you just put on the screen, the GLD. It's a different one. It's the one with lower fees than that one.
Ah,
And then also, I'm a long-term believer in Intel. So I've got some
Intel.
Intel stock, and there's something else that I can't think of right now. I
Happy
think it was,
shareholder if we were in Intel for this week. At least just a post earnings, it jumped up, but I think it came back down.
yeah.
But maybe
I
changing fortunes on Intel.
actually bought into Intel when it dropped down below $10. So I'm kind of happy about that right
Yeah.
now. So yeah, I just want to learn a little bit more about maybe how to 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 invest in stocks in a different way than the way that I've been doing it. I don't know anything about investing using options.
Well,
Uh,
that's fine. And again, I think I'm always of opinion. I always emphasize find out what works for you and just stick to it. I mean, it takes for me also it take me a few years to understand me as an investor and what would work for me, and that's all. I'll just stick to that. And if you feel that your mindset or emotional makeup is not for doing on AI or little more volatile stocks, or maybe you don't have a time to look in on options, perfectly fine. I mean, there are many. So on this market, there are many ways to make money. Figure out what works for you and then stick to it. So I would highly, I mean, my educational opinion would be just don't run or go after what other people are doing. Learn, try it, find what works for you, and then stick to it.
Sounds good.
Um, it says I work in healthcare. I have an interest in investing too. Cool. All right, I guess so. Let's get going with our regular agenda for those who are joining for the first time. The way we do this meeting is I'll bring what I see in the market, start at a macro level, look at some equity stuff, what's happening at company specific news. Then I'll pick up a particular topic to discuss. Like for this week, I picked up is AI in bubble as a topic, and then probably also get into the fear and greed index. Every week I bring that the CNN fear and greed index, but for whatever reason I thought at least this week didn't seem to be giving the right information, so I tried to dug deeper, and then I'll give you my thoughts on that. And then finally, we look at the crypto side of the house investing, because now I used to do separate session for crypto, but over the last few years, our traditional finance and the crypto have kind of merged. So that, and I include crypto in this one, our this session itself, and then we'll break out into the breakout rooms, and you can then talk about whatever you're interested in. We have a breakout rooms for options, futures, day trading. I don't day trade. So if you have any questions around day trading or gamma scalping, I can't help you. But there are folks in this group who could. You can go and talk about those day trading in those different breakouts. So, so that's how we conduct the business here. I think the initial discussion takes maybe around 2 hours, and then once we get into the breakout room, I'll start driving to go out for a lunch, but I'll jump on to the self to sell. And do we have Shri here? Well, one of you generally is kind enough to become a co-host so that we can continue discussion in the breakout rooms. And that goes in for whatever time, half an hour, 1 hour, 1.5 hours. So that's how we do it here. So, and I appreciate you guys coming in here and spending 2 to 3 hours every Saturday. So thank you very much. Again, if you have any questions, put it on the chat. I will monitor it. Or you raise your hand and I'll basically invite you to speak and ask the questions. All right. Anything else? Logistics, everything all cool. Raj say he wants to do it. Go ahead, Raj. We can have one more introduction before we jump into today's session.
Thank you, Vivek. Yeah, no, this is my first time joining this group, and I've been interested in trading for almost 20 years, starting with Jim Cramer and Scott's Trade, if anyone remembers.
Scott Trade, I used to pay $7.
Yeah, $7. Yeah, and they had a physical office in Hartford, Connecticut, near me. So I've been trading a long term, and my long term investments are kind of index, and they do well. I mean, do well as in like because it's long term, so you compare it to long term. For short term, I had this thing of I start trading and then I make mistakes and then I'll stop trading, start trading options or futures, maybe blow up few accounts and then stop trading. So in 2020, I started looking into Python, and since then I have start developing algos, like small Python algos, which run automatically. And that way, I think that helps me not make mistakes that I made as a short-term trader. If anyone is interested in algo trading, they can message me or join me on LinkedIn. But I think algo trading is really good if you know some Python, because then you don't make those small mistakes.
You get your emotions out of it, right? It just you set the rules and then it will do it.
Right, and also like when I'm traveling, even then my algos are working. So you were showing gold chart, like I went long in January and then went long in August 2 times to capture that move, and it was kind of like real time. And I also use my IRA and not Thinkorswim, but this is Thinkorswim, right?
Yeah, this is Thinkorswim.
Yeah, I use Schwab, and Schwab has a really good API. Although it's a little bit complicated initially, but Schwab has a really good API to buy and sell both options and stocks.
Cool. All right. Yeah, now Thinkorswim is anyway Schwab.
Yeah.
It's one last thing is we do have a Slack group. If anyone interested in connecting or chatting offline, because we meet once a week, I will put the link to the Slack group in this chat. Hop in. It's not too noisy because I myself don't, like I said, I'm not a day trader. I'm not looking at daily signals, etc. But if you have questions and you don't want to wait until the Saturday meeting, put it in the Slack. I do monitor Slack on daily basis, and we'll be able to, if not me, someone else can respond to it as well. All right. So with that, let's get started, guys. We have enough quorum. Today is our discussion number 297. Maybe before the year ends, we'll have 300 sessions done. So thank you for showing up and motivating me to continue conduct these sessions. Like I said, our main topic would be the bigger topic I will tackle today is AI in bubble. But as always, start with the macro level. What happened this week on the macro side, and then we look at some of equity specific or a company specific news. We'll go through that and look at the crypto, some interesting charts, etc. And then finally you know, go into the breakout rooms. And as always, anything that we discuss here, please don't take it as a financial or investment advice. Uh, I spent all of my corporate life on the tech industry. So you don't you know you can't do worse than taking financial advice for me. I have no background on the financial services, etc. So before I jump into the real con, I do want to start our discussion with some investing thoughts. For me, I think the mindset is the most important thing when it comes to investing. If your mindset is not right, there's just no way you can actually make money, right? So for me, EQ is more important than IQ. So the quote I want to start with is to compound, you need to be around, right? And this actually I tweeted it in response to someone who had posted the results of QQQ, and you say, hey, if you look at the Nasdaq or QQQ, it's been have had a stellar results year over year. Why should anyone have anything else in their portfolio? So I just responded. I said, in 2000, Nasdaq was down 80%, and that would wipe out a lot of portfolios, and most investors will just never come back into the market. So if you really want to be compound, you need to be around, and that's why you need to have something else than QQQ in your portfolio should a similar situation arise. Right? All the returns, 20%, 40%, 50% returns looks great, but if you're not around, and some of folks I know didn't come back after 2022 drawdown, right? And the markets have done great after 2022. But if your portfolio wasn't positioned properly, let's say in 2020 and 2021, when the markets were like going crazy, and all you had was Chamath's SPACs or the non-profitable, let's say Cathy Wood companies, you would have made great money in 2021, but probably got wiped out in 2022. And then missed out all the gains that market has done over the last 2 years, almost now 3 years, right? Since 2022, it's 3 years. So to get the compounding wealth, make sure do everything that you can do to just increase the longevity in the market. Market anyway has a tailwind or to the upside. So you don't have to do anything great to make returns. Just don't have to do stupid stuff. All right, the books that I'm currently reading, actually two simultaneously. One is Expectations Investing from Michael Mauboussin. I've probably read many letters of Michael Mauboussin, and I will bring about the summary of these books. But one thing that struck me from reading that book, I'm in a few initial chapters, is he talks about not trying to identify. I mean, you try to run your discounted cash flow. You have a lot of assumptions you have to put in. So it says instead of doing a discounted cash flow, you can also find out what the current price is assuming, what expectations of cash flow generation is assumed in the current price. And those who have been around, the process that he defines is exactly the process that I have shared with you, and I do whenever I do a company analysis, is a reverse discounting cash flow, right? Instead of me trying to assume what the revenue growth will be, what the margins would be over the next 10 years, we don't know what could happen in next 10 years. But if I look at a pricing, I can find out what the market expectations are of free cash flow growth, right? Does that seems too absurd? Yeah, you can make some intelligent guess. So to me, it looked like we were doing the expectations investing without actually knowing the term. The other book that I've studied to read over the last 2 weeks is Rule Breaker Investing from David Gardner, co-founder of Motley Fool service. Basically, they have a services around the stock reviews, business reviews, and all that. And I've been following Motley Fools and their podcast for a few years, and I like their thought process. All right, so that's the initial thought process. Let's get into the market. So let's talk about the TradFi and what's happening at a macro level. Now we are in October, 25th. That this marks the third anniversary of our bull market, right? If you remember, the market bottomed out on, I think, October 22nd, maybe 2022. So now we are on October 2025, continuously 3 year of bull run. Markets are close to 90%. When I say market, I mean it S&P 500. Right? S&P 500 is up almost 90%, 98% if you include dividend. If you since it bottomed out in October 2022. Right? Now, if you got scared or chickened out of the market in October, you almost missed doubling your portfolio. Right? This is why I always want to emphasize, find out what works for you, what increases the longevity in the market, and we should be fine. Is it too much? Right? What, 3 years market almost double? Should we expect the market to cool down? No, I don't know. I have no idea what market will bring in next few years, 1 year or next 12 months or next 2 years. But I do have fairly good confidence on markets will do better than where they are currently in next 10, 15 years, right? So words that wreck investors are, market should go down now because it's hitting new all-time high. It's been up 98%, including dividends in last 3 years. That's too much too soon. It should go down, or it must go down, or I'm sure the market will go down whenever. So I take these words with very seriously and say, whenever, if in your own opinion you start to use these words, sure, must, should, you should step back, because whenever you are overconfident, this basically shows overconfidence, and that's what wreck investors. Always be humble, because market will always surprise. Give yourself room for error. That's what I use options, because I don't know, maybe I'm bullish about the company, but I could be wrong, right? So never ever be overconfident. We'll learn the lesson really hard way. So far, we have survived almost 6 black swan events. And this is what Tom Lee, this is not mine, this is what the Tom Lee says. We had a COVID and the whole economy was shut down. Then we have a supply chain impasse after COVID, right? The goods we didn't have the whole, from the ports were shut down, the shipping, we talked about it during the COVID, right? Exorbitantly high. We had the highest inflation in almost 40 years, and then followed by the fastest rise in Fed funds rate in the history of Feds. And then we had a geopolitical issues. We have a wars going around, and then finally we have a tariff imposition by US. And what the market has done, I mean, if we don't look at S&P 500 and we talk about that, these are the things that happened in past 3 years, without looking at the market, there is no way one would say, yeah, I think the stock market is doing great. We have had so many issues, and yet the market is where it is, right? Has continued to climb up all the wars of worry. So that might lead us to think, come on, this is unprecedented. I mean, if we are investing for a few years, we haven't seen this before. It's unprecedented. So quick, market has climbed all the wars, the worry and all that stuff. But is it unprecedented? So we looked at a little bit of a history of the average bull markets. Right? This is not an outlier. So if you're trying to I mean, I was a little bit guilty of thinking that it's too much too soon in 2024. And I talked to you saying, hey, you know what? I'm not adding too much deltas. I was just holding whatever the deltas I had in my portfolio. In 2025, I changed my opinion because the markets have been proving me wrong. So I'm like, yeah, probably I can go a little more long on my portfolio. And that has worked out wonderfully. So looking back over the last 80 years, 12 bull markets, right? The average gain is around 200% and it has lasted 5 years. We got only 100% so far. And we are, what, 3 years into bull market? Right? By the way, average is different, right? So you can't always go with averages. And history doesn't always repeat. It may rhyme, but it's just good to look at what has happened in the history, right? I think there's a famous quote from someone, I forgot who, like, uh, in especially related to the markets, is things are unprecedented in the market for those who don't study history. But there is nothing new that happens in the market. Just that we have not looked back and see what has happened in the history. Right? 8 of those had more than 3 years. Maybe this one will be the ninth one. 2009 to 2020 was the longest bull market before it was interrupted by COVID. And then we entered into the bear market territory in March. Right? As the saying goes, bull market doesn't die of old age. Just because now it is a 3 year doesn't mean it will die. It will die from recession. It will die from tightening. It will die from maybe over expectations and the earnings don't performing. The market doesn't perform. The company's results are not as good as what's been priced in. It just won't die just because it's been 3 years of market. Right? So here's the chart around strength and the length of bull markets. So the red one is where we are currently. And there have been a lot more bull markets, much stronger. I mean, 3 years, double 90% gain is great. But there have been many more bull markets in which it has done better than this, right? So maybe look, history does give us some insight into, hey, this is not the first time, right? Average bull market return per year, right? So these are different bull markets, 20 from October to now, it's 29%. Okay? There have been other bull markets where we have done poor, but pretty decent, 29% per year. Pretty decent. I mean, much better than what you can get on your CDs, and only God can help if we had all our money just sitting in a savings account, which gives 0.02%. So what else we had this week? We had inflation numbers that came out. So I thought that because the government is shut down, we will not have inflation number. So I was surprised. How come the inflation number came out on Friday? Then I realized the Social Security Administration, they'll need this number to do the cost of living adjustment. So Bureau of Labor Statistics, they called back the furloughed workers just to generate these numbers. So headline CPI rising 0.3%, better than expected, means less than what was expected. Core, which exclude food and energy, that was also less than what was expected. On annual basis, that too was less than expected. So from inflation side, inflation is cooling down. I mean, we have seen over the past few weeks also that the inflation chart is coming down. But now this September report was even better than what the market was expecting, right? So it's under control. I will wait for maybe 2 more months. I think I told earlier that when the tariff was imposed, I want to wait until December to see the impact of tariffs. Right? But so far, tariff doesn't seem to have caused an increase in inflation, right? So what were the key contributors? Housing inflation slowed, which is a weird way they measure the housing inflation. If they call the house owners and say, what's the equivalent at what rent, what price would you be willing to rent your house? That's how they look at housing inflation, which is a weird way. I mean, why don't you look at Zillow? Why don't you look at Redfin? I think we need alternative sources of calculating inflation, but given what we have, given the whole of our economy looks at this number, that's why I'm reporting this number. I don't have too much faith on this number though. Goods prices rose slowly because the used car prices were lower, and services inflation also was lower with a drop in car insurance costs. So these are some of the factors that contributed to lower inflation. If the inflation is lower, we also have a Fed meeting, FOMC meeting next week, where expectation is, it basically paves the way for Fed to cut the rates. So there's 98% probability, 98.3 to be precise, that we'll get a 25 basis point cut. There's some chatter that given the inflation number, Fed may cut even 50 basis points, right? Market is not pricing in. So if we have a 50 basis point cut, expect the market to rip even higher. But market is pricing in another rate cut in December, another 25 basis rate cut in December. So we'll have almost three rate cuts this year, right? And what's happening? Earnings season is kicked off. Earnings season, as always, start with the banking first, financial institutions, and this coming week we have a big tech companies reporting earnings. I forgot to have a chart for our next week's earnings. Maybe I'll pull it up from X. In terms of the companies that are reporting earnings in this coming week. So we have a lot of big tech companies reporting earnings. So that could move a market, could keep the market a little more volatile. So markets are currently at all-time high, SPYs up almost 16%. PE is between 27 to 30, depending on which source you look at. Someone will have forward PE, someone will have a PE, someone will have a TTM PE. But I looked at a few sources, consider between 27 to 30, which is generally pricier than what the historical PE would be. Not that I'm going to put a lot of emphasis on the historical one, but because the type of companies and the businesses that drive the S&P are very different from what we had in history, right? So maybe the base level of S&P PE itself is going higher. But given that we already have a valuation as 30, it will be the corporate earnings that will have to drive the market further, right? This is all Fed rate cut is coming. Investor enthusiasm, they have done their work. Now the corporates' earnings will have to do their work. And currently the market is expecting EPS growth of almost 9%, which is healthy. Right? Despite all the stuff that is happening, we're still expecting the companies to post almost 9% EPS growth. So, so far, banks have reported, and few companies that retail investors are generally interested in, they have reported it, like Tesla reported it. Some couple of semiconductor companies have reported results. TSMC have reported, ASML has reported, and Intel has reported. Mostly to gauge what the consumer is feeling about the economy. You'll get that information from the banks. If you listen to the bank CEOs in the earnings call, they'll tell you what the consumer is feeling. They don't know. They know what the consumer is spending, where they're spending. So far, consumer is resilient, especially the higher income people. They have a stable credit quality, and the M&A activity have picked up. So I was reading somewhere, looks like the M&A, the overall value of M&A activities that have happened so far this year is higher than over the last 5 or 6 years, right? So a lot of M&A activity is happening, and corporates will engage in M&A only if they think that the future is going to be better. So it's maybe I think despite the fact that the market's at all-time high, company earnings growth is close to, we're looking at around 9%. Consumer is stable, M&A activity, right? So I don't think it's a time to just become bearish. But tame your expectations. Be real. S&P has gone over 100 days without a 5% pullback, right? So, and some people may want to take some profits if they see any glitches or any gotchas in the market. There are some uncertainties. I call it as uncertainty because we don't know how the earnings will come out. So in the near future, we got a mega cap tech earnings this week and the next week. And if when you look at a mega cap, if we look at top max 7 or look at top 10 companies, they constitute almost 40% of our index, right? So any weakness in these top mega caps could cause some volatility in the market. We have a tariff negotiation deadline with Mexico. We have a discussions and like 100% tariff on Chinese goods. And then we have I think President Trump is traveling to Asia to have discussions with Asian countries. And I think the big focus will be our negotiation between US and China. So this could move the markets. Short-term volatility aside, we want to focus on what's going to happen in next 2, 3, 5 years, right? We still have a rising corporate earnings. We still have a stimulus via the tax refunds and of course the deregulation, which the administration has promised, will also be friendly to businesses. We'll have a continuation of Fed rate cuts, right? We'll have 2 this year, another few maybe next year. And there is a lot of a dry powder which is sitting in the money market funds. So right now in the money market funds, you can get 4%, 4.5%. But if your Fed funds rates start to come down, the money market, the rate on the money market funds will also come down. The question is where this $7 trillion or $7.4 trillion, which is happy making 4%, when that starts to become 2.5%, where they're going to move that money, right? To gain the same yield. Expectation is that some of that will come back to the stock market. So there's a huge pile of money still sitting outside the stock market because, hey, my life is cool if I can make 4.5%. Why do I need to take additional risk? But if I can't make that 4.5%, then that will be a challenge, right? But these all are the tailwinds that could still happen behind the market, right? Let me get through some of the questions which I missed. Dave is saying, so sound like you don't always sell covered call and long-term holdings. You're only hedging using option. What strategies to use hedging? I do sell covered calls, but like I talked earlier, right? Looking at how the market, the direction is, I will tone down in terms of what delta I'll sell the covered call, what quantity of covered call I'll sell. If I have 200 stocks, probably I'll sell only one. Or if I have 100 stocks, maybe I'll sell a call spread, right? But I generally will have a covered call or some option trade on my long-term holdings, right? And if you go and look at, you can go and look at my trades, right? They're all on the website. So I will generally have it. Now, when it comes to the hedging, my hedging, of course, the selling option premium allows me to reduce my cost basis, but I will, just from a hedging perspective, I will have short calls on SPY, QQQ, just to control the deltas. Nothing more than that. If I feel that my deltas are higher than what I want it to be, I will just sell a call, right? And let's say the markets continue to go higher, so I lose deltas. So this week I added a little bit more. So it's all about what you feel you are comfortable with, and then you can use options to basically express your opinion, and that's all I do. Nothing rocket science here, right? Sri, there's a market a short-term memory and long-term hope. Let me see if there is any other question. Sam, I see your hands up. Let me go through the questions, then I'll invite you to ask your question. It takes average 6 to 18 months for fully reflect. Yeah, I mean, that's what I. So when it was announced in April, I said I want to wait until December to see what happens on the tariff front, right? Ed Johnson, if you're comfortable that the market is looking good for long term, ever buy long term leap option on QQQ or SPY? Uh, if I want to buy a leap, I will go and do a deep in the money leap. That would be basically a stock substitution, right? So that will be more from a capital efficiency perspective. Uh, I can go and do a deep in the money leap option and then probably sell some covered call against it. Basically, do a poor man's covered call. Have I done on QQQ or SPY? No, I hold QQQ and SPY on my portfolio, and I just sell covered calls against it. But for someone who wants to play in a leaps, currently buying calls will be expensive because the Fed funds rates are a little higher. But yeah, go deep in the money so that you don't pay for extrinsic value. Yeah, that won't be a bad trade. Just that, I mean, I have not done it, but I would say, yeah, but there's nothing wrong in doing deep in the money as a stock substitution. Sometimes I've done stock substitution, well, to basically just sell a at the money put and buy at the money call, right? I have done that a few times. Leap I've done earlier, but is that my preferred one? No. But there's nothing wrong in it if you want to do it, right? But as long as if the wall is higher, yeah, so I think Terrell is mentioned. It is expensive because the wall is higher. And also because if you're looking at a leap, you're going out, at least 12 months, 18 months out. And then because the interest rates are higher, you have to pay a lot more for those call options. So today on Twitter, I see a lot of a newbie option traders coming and say, hey, they come and talk about selling covered calls as if it's a new hack that has been discovered and you can just make money by selling covered calls. No, dude, you've been around the block for a few years. Today you can get a premium because the interest rates are higher. Let Fed start to cut the interest rate, you're not gonna get the same amount of a premium by selling covered calls, right? But and VIX is at whatever, I don't know where's the VIX is right now, 15, 16. I know it did decrease a bit, but still it is at 16. Talk to me when the VIX is at 7 or 8, which is was in 2017. It was not as easy to sell option premium, right? So but yeah, right now everyone is making money, everyone is excited about it. Selling options, selling covered call is a new hack to that someone has discovered. It's because the markets are favorable, right? So anyway, so was there any other question? Thoughts on Ferrari falling? I've not been uh, following Ferrari, but I think I did see a chart somewhere that their operating income was negative. Something related to that. So if you're interested in Ferrari, maybe just look at their financials and see how their what's the ticker? I think its ticker is Rush or Rash or something like that.
Yeah, race related.
Race. All right. Let me just bring up and see if we have. I don't have Ferrari in my portfolio, so I don't pay attention to it. But let's look at a quarterly. Oh, this is June 30th, so they have not updated for the recent one. So I think it has something to do with the recent results. Probably their operating income their margins were squeezed, or their operating income was negative. So just search on that. I think that may be a reason why Ferrari's fallen. Again, I have no idea. I just saw some chart about Ferrari somewhere, and I didn't even know that the stock has actually fallen down. Race. Oh my God. Okay, that's a huge
Yeah.
drawdown.
I think they've revised their future forecasts, but yeah, I haven't looked deeply into it. I was
So their earnings is actually later.
Yeah.
Oh, they gave a revision?
I just saw a high-level headline.
Yeah. So if you want to, maybe next week I can bring up and run through my checklist and see. But I know the Ferrari has been the darling of some of the value investors.
Yeah.
The stock has performed really well over past 3-4 years, and they say, "Hey, you should have gotten into this one." So I know Ferrari has been talked about in like Moish Pabra, Guy Spear, those circles.
Yeah.
But I never owned this.
Yeah. Yeah. I think it's one of
Yeah.
Pabrais regrets selling it too soon.
Yeah, he
Otherwise, he
sold
would
it
have
too soon.
owned 1% of it or something.
Dave, when are you going to update secure certificates? Oh, let me look at it. It says not secure, but I do have SSL certificate on it. Let me go and see if it is need an updation. Another one that caught was attention APH. APH is, I think, Zamphenol, Sridhar. Actually, I had put this on my like a watch list because one of fund manager that I hugely respect. I respect his analysis, John Rotonti. I think he wrote about Amphenol. And I know that this basically provides you the plumbing around the whole data centers, etc. But I mean, the stock did really good after earnings. But again, I don't want to, uh, have another ticker in my portfolio that is dependent on AI tailwinds. Maybe I'm looking at something to buy an ETF, um, which basically will have multiple of these companies in it. But search for John Rotanti's notes on Amphenol. He has done a good job of. Again, I've not gone through his notes. I saw his, I think maybe on Twitter, he mentioned about this company, and I like John's analysis. So I had put it on my watch list, but never got to actually do analysis on the company. But this is related to the tailwind is of, I think they provide some of the back end around managing your hardware, etc., on the data center side. SE down slightly, who cares? I mean, down on from 190 to 150, it's okay. I mean, these
I
are all
think
are long-term.
sharing in terms of as a potential entry.
So that I mean, I own this. I think currently I have a put spread and a covered call in a custom trade. So if it fall down, maybe I think I have a short strike is at 140. If it goes below 140, I'll probably buy a little bit more. If it goes above, I think 190 is my covered call. I'll sell a little bit. If it stays in between, I'll just reduce my cost basis. Right. So, I mean, look at if you really want to see if it is, right price point, etc. I don't. I mean, I don't think I've looked at it over from a valuation perspective. I've done it any recent valuation on or run it through my reverse discount on C Limited, right? Doesn't seem to be too expensive just from a pricing perspective, though. But don't take it as this like 10-second analysis.
Yeah.
Right. I mean, I like the overall the company. I like the management. I think I did put it on LinkedIn. I've never seen any management of any of the companies that I hold in my portfolio actually did what Forrest Lee and his team had done in 2023. So that was an unprecedented. Let me give the name, John Rotonti. He recently joined as a portfolio manager with Bastion. He used to be with Motley Fool. All right. I think I answered all the questions. Yeah, Sam, go ahead. Your hand was up. Okay.
Yesterday, I was watching another Singaporean investor. He said, if you had the Nifty 50 in the early 70s, all the companies were bankrupt except Walmart. So, in other words, I just threw in some AI searches. Walmart has outperformed S&P 500 from IPO. So, if you had invested, sorry, that's actually I'm old enough to figure this out. 50 years, you would be ahead of the S&P, just one stock.
Yes. So I think Monish Pabrai talks a lot about, I think it's Monish Pabrai only, right? Not, or Monish Pabrai or Guy Spear, one of them. They talk a lot. I think it's Monish Pabrai. He talks a lot about this, saying Nifty 50, if you had equally distributed your portfolio among those Nifty 50 means 2% in each of them, right? And then a lot of companies went bankrupt. And you're right, Sam, a lot of companies went bankrupt. But just holding that Walmart, if you had held it till date, you would have outperformed S&P 500. Right? Yeah, there are some companies who will do wonder, but the question is, can you identify those companies, right? The ASU professor Henrik Bessenbinder, right? Only 4% of the companies are responsible for all the gains in the stock market. I don't think I am qualified enough or smart enough to identify what those four companies would be. And that is why index investing probably is the best for most of us, because it is very hard to find those great compounders. Only 4% are responsible for most of the gains in the stock market over long term. So the question is, do you want to find the four needles in the haystack? Or I think it's Charlie says, just buy the whole damn haystack, right? So I'm like, even though I do invest in individual companies, my biggest holding is still S&P 500. I looking at equity Apple iPhone sales. So if you look at what drove Apple higher, and most of the investors were worried that Apple is falling behind in AI, which it's true. It's been losing a lot of their AI engineers to other companies, and so far, no clear direction on what they're gonna do with their what's their AI game plan is. Siri is one of the worst I would say product that you see out there, but it's still a great company in terms of hardware manufacturing, right? And so there looks like the market research from I don't know which company was it, but that suggests that iPhone 17 sales seems to be stronger than iPhone 16, right? And if you know Apple, they generate billions and billions of dollars of cash. They can buy back all the shares. I mean, Apple has bought back, if I recall the numbers, maybe around 700 billion worth of shares. Right? They can continue to buy back the shares, and the devices are in 2.5 billion people pockets, right? Or maybe a billion. It's all when we talked about Apple, the numbers are always in billions, right? So you can't just count the Apple out just yet, right? And they're sticking to what they are best at. And it's perfectly fine. You don't have to create your own basic models like LLMs based models, because they're gonna be commoditized in a few years. The idea is, how can you make use of those LLM models and include in a customer experience, which is what Apple will do. But so far we have not seen clear AI strategy from them, and that's why the market has have been punishing Apple. But iPhone 17 sales kind of change the expectations that no, I think that there's still a demand for their hardware. And I think one of the reason why over the last 2 quarters we have seen an increase in iPhone sales is because Apple agreed to be a part. They lowered their prices in China, and now Chinese government have been giving a lot of incentives to their citizens to go out and spend, and they're subsidizing some of these devices. So as of 2024, Apple was not, iPhones were not getting subsidy from a government because the price point was higher. Your devices have to be below a certain price point to qualify for those subsidies. Last quarter, the iPhone sales in China did increase because Apple was then a part of that subsidy program. And I think probably this quarter also why we are seeing the growth is maybe the growth in the China is higher because now if you want to buy an iPhone, you can get the subsidy from government. Right? Amazon, what did we have on Amazon? Amazon shut down the internet, right? Snapchat, and there are a lot of other companies. I took a screenshot on the day when it was down, and later on I saw, a lot more companies were down. So basically, half of your internet was down. This also tells us, how concentrated all these players have become. We got what Amazon, we got Azure, and Google Cloud. Now the Oracle is fourth one. These all four private companies can just shut down all our lives, right? Amazon goes down. People lost sleep. When I say lost sleep, literally they lost sleep because I think there's a company called 8 Sleep. They have those high-tech mattresses and all that stuff which will adjust to your sleeping pattern and all that. And when the AWS was down and they did not have any local computation, so your mattress did not work the way it should have worked, and people actually were woken up from sleep and say, why this is so hard on this? And I don't know how exactly 8 Sleep works, but you get an idea. And then they were like, how come the company did not have anything which can, will work when the internet is broken? So people lost sleep. I'm sure I think Robinhood was down for some time. People would also have lost some money in the portfolio, etc., etc. We saw similar breakdown in internet in last year when the CrowdStrike was down. On July 19th, they broke a lot of companies, but the life moves on. And surprisingly, the Amazon stock was up the next day. You would expect that the Amazon stock would be down, but the stock was up after that. So I'm not going to get into the details, but looks like some DNS entry was wrong. How a one DNS wrong entry can bring the half of the internet down, that always surprised me. And now there are jokes and the memes on the internet saying AI, it was done by an agentic AI. Who knows what's truth in that? But it was I think, a wrong DNS entry that brought the whole East Coast region down. Thing that we want to focus on, we also had the data coming from China. Industrial output is bigger, is higher than expected. GDP was in line. Retail sales were up year over year. The thing that is still in doldrum in China is what property stuff, right? This is what has been ailing China and the Chinese consumers, which have most of their wealth or net worth tied to property. Property market is still falling, right? And the government has been trying to do all what they can to prop up the consumers, giving subsidies to sell, easing conditions for property developers as well as for loans, etc. But consumers are, if your biggest net worth, the majority of net worth is tied in property, and you see the prices going down, you just don't feel like going out and spending, right? So despite whatever has happened on the Chinese stocks this year, they have performed really well because they were coming from the most pessimistic scenario. Remember, right, in 2023, we talked earlier when Alibaba was available at 17% free cash flow yield, and no fund manager wants to touch it because China is dead. Chinese fund managers were pulling money out of China, and I'm like, come on, they're available so cheap. And now they're getting back in China. So at least I hope some of you took an advantage when I bought Alibaba and gave you my bullish thesis of Alibaba early 2023. Now everyone is now looking back at China. So property weakness is still threatening consumer confidence. One interesting part is their industrial output and their export. there wasn't as dented as what we thought it would be, because China is now exploring other markets in Asia and Africa. And I know because in Africa, I own one of our e-commerce company in Africa, and they have found that a lot of Chinese suppliers are a lot more willing to work with them than they had in the past, right? So at least I have one evidence of China reorienting their exports to other continents and other countries and try to reduce their dependency on US. Whereas we have a lot more dependency on China about rare earth minerals, because 90% of the rare earth minerals are processed in China. We hardly have any. But we are trying and going to other countries like Australia and UK and Brazil. I think it's Brazil or Mexico, one of them in our Latin America, to secure the supply for rare earth minerals, because we have a negotiation coming up with China, and they will have a leg up if we don't have a secure supply of rare earth minerals, which we need. We need for all these EV, we need for all these robotic humanoids, etc. We need all those rare earth minerals if those dreams have to come true. So Chinese stock performance this year, Alibaba is up 100%, right? This is, I think, Tencent Music, XPEV. These are all the auto companies, but so far so good. Right? JD and Lee haven't performed, but overall Chinese market have done great. Even if you're not doing individual Chinese companies, because of course there's a company specific risk, you can pick up FXI, which is large cap China ETF. It delivered twice the performance of SPY this year. SPY is up around 16% and FXI is up around 33%. Jose says KWEB. Yeah, KWEB is the internet ETF, which is almost 38%. A pretty decent run on Chinese equities. In fact, this year, a lot of markets outside US have done better, right? Over the last 10-15 years, all the money was in the US, right? Where else are you gonna go? Emerging markets, EM. I mean, we always heard the emerging market cheaper, so you should outperform, or the EFA, etc. But no. But this year, a lot of non-US markets have done much better. Turkish market has done much better. German market has done much better. I think Taiwanese market has done better, and Chinese market has done better. So having little bit geographical diversification in your portfolio could be useful when money is also moving to other parts of the world. So I did post out what's my portfolio leaders and laggards are. So here's my top 5 for this year. This is the African e-commerce company that I was talking about. Now they're getting a lot of traction with the Chinese suppliers, up 175%. Palantir is like last year also, Palantir was up like gazillion percent. This year another 140%. Alibaba 100%. Intel is up 87%. And this is another Chinese company up 80%. Laggards, Trade Desk, down almost 54%. Going down, Nanox, Fiverr, DocuSign, PayPal, down 20%. Despite all the positive stuff that I'm seeing on a PayPal in terms of the business side of the house, the stock hasn't really performed. Right? It is what it is. You will always have companies that will underperform the market or will try to drag down the portfolio. You can't have all winners. If I have a 30%, 40% winners, I think I'm good enough. So, because some of the winners will basically carry your portfolio up. You can only lose 100%. Provided you're not leveraged, you can only lose 100% in the stock investments that you have. But on the upside, you can make 100%, 200%, 300%, 10,000%. Right? So that's the fun on investing. Anyone wants to share what's your the best performing and the worst performing? We won't have a time for the top 5s, but what's the best performing as stock you have in your portfolio? Let me get some poll out. Anyone wants to share what's the best performing stock in your portfolio and the worst performing? I mean, you should know this. If you are active DIY investor, we should know which one is doing, which one is not working. Terrell Simmons is AMD. I think I think this 1 month of AMD, what it was up like 55% or something like that. AMD, yeah, I think this month carry you as the best performer. Intel best is Intel. Dave says Intel. Worst performing is Smile Direct. Because I guess that's because of China. Smile Direct, WBD, Warner Brother Discovery. Is that the best or the worst? I think that's what WBD is. Right? They are on sale now, so probably would have jumped higher because of their exploring sale. And I think there are rumors that maybe Netflix is interested. I think they are quoted by a few of these streaming companies. So, yep, the stock had a pretty nice run after that. Ray Khan has says the best is Celestica. I don't think in last 4 or 5 years ever anyone talked about this company Celestica. What it does. Oh, this is Canadian company. That's why I don't hear about Celestica. Is it TXX? Is Toronto Exchange, right? I think so. What it does is supply chain solution, Asia, North America, international. Okay. ATG. Interesting. But it is listed. Oh, it is listed on NYSE. What is driving Celestica? Something, I mean, revenue growth is tepid. I mean, last 2 years been higher. Maybe AI play. Again, I never heard about this company. And the worst is Stride. Is that the MicroStrategy stuff? Or is it Ray? Is this LRN?
That's a yeah, LRL.
Okay. Because the MicroStrategy has got a lot of its Stride and all that stuff. So I got a little bit confused. Is it that stuff or not? So what is this company? Again, I've not heard about this. You definitely have some interesting companies that I don't see a lot of people talking about it. Online curriculum, software system, educational services. Interesting. So yes, LRN. You said that's the worst performer, LRN. LRN, year-to-date change is like 43%. If that's your worst, you probably is doing great. Your portfolio is doing super, super great. Right? It's like, yeah, the worst player in my team is Steph Curry, man. I don't know what to do. He's the worst player. You can't complain about worst player being 43%. Vivek says Palantir is the top one. Raj says AMD and TQQ, which is, I guess, leveraged. TQQ. Remember, TQQ is it's double leveraged, triple leveraged. I think it's probably triple leveraged. Meta, TTD probably the worst performer. Yeah, TTD has been, and I think I might change my opinion around TTD because they're getting so much tough competition from Amazon. Even on Friday, there was a news that Amazon is offering some of the customer free trial, and that's like, ever since Amazon moved into DSP area, TTD have had a tough competition. So they was short QQQ. Obviously, QQQ is up. Ray, I'm up 100% over last year. That's great. Just make sure we don't know. 1 year doesn't tell anything about our performance. We need to look at what we've done over 10 years. I have seen many screenshots of triple digit gains in 2021 and they all disappeared from Twitter in 2022. Just want to make sure be around. The time will change and we have to just make sure that we are able to weather all portfolio bull or bear. versus Etsy. Oh, I've never owned Etsy for last 3-4 years. Aditya say versus Intel, you exited at the wrong time, so it's out of your portfolio. Nvidia, Avgo, yeah, all this AI. Costco said worst is Costco. Maybe you entered Costco at the wrong time because the Costco last year was, I mean, they've been very expensive. It's a great business, but trading, I don't know what it is trading right now, but last time we looked at it was, they were trading like 50 times sales. I'm like, come on, it's a retailer company. Of course, it's got a subscription model, but it was super expensive. At least it is much cheaper right now. This used to be about 50 or something. Yeah, and if you entered at that, probably the valuation is cut into half. All right, what other new one? I'm not GIS. GIS, is that a prison company? Oh no, General Mills. I think that was it. Okay, Staples. Staples haven't done that great this year. If I look at XLP, with the consumer staples, look at year to date, it's like, eh. So obviously individual companies, probably some have done bad and some would have done good. Overall staples sector hasn't gone anywhere. Best is Tesla versus Confluent. I don't know. I mean, Confluent I looked at when it came IPO and haven't gone. I was in a similar company where, and Confluent is like a single product company. I wasn't very sure about the overall future of it, so I never invested in it. And I think that time I also tweeted about it. It's a one pony trick unless Confluent move into different areas. I mean, they were all based on Kafka and haven't spent some time in this industry. I wasn't too confident. I don't know where Confluent is right now, but I know a lot of people were very, I would say, enthusiastic about it when Confluent came for IPO, right? But yeah, has been a pretty dismal performance. And now you're trying to build a product on top of an open source and a single product. I mean, the company, you're not a decision-making factor when a company deciding, an enterprise is deciding around the IT budgets, right? So, worst is Marcus is worst is on is that on shoes, I guess, or is that on some semiconductor? Oh, this on holding is probably the shoe company.
Yeah, that's right.
Yeah. So there's a lot of some of these shoe companies, and again, for me, that's why I don't invest in anything that is related to consumer fashion. Because these are fickle. It takes years and the decades to build that brand loyalty, right? We have seen other companies like Allbirds, On, like now even Lululemon, etc. Just these companies always have some great time, and then most of them will fall wayside. Very few companies will be able to change consumer taste and the preferences. It's very hard to build it. That is why, I mean, I personally don't have any way to evaluate this thing, so I generally stay away from anything that has to do with the consumer tastes. Right? We have so many new cola companies coming up, right? Some of them in some year have done triple digits gain, like Celsius Holdings. It was like the darling of all the retail investors. But I don't understand, this industry, so I'll stay away. And some of them could become good. It's very difficult to change the consumer taste and preferences and build a loyal brand. And that is why we have a very limited number of, the companies in these spaces which have survived over 20, 30, 40 years.
But Nike did do that, and it's still around and
Yeah,
relevant.
see, Nike is still struggling, right? So it's, of course, Nike's problems are all created by Nike. Let me tell you this. Nike's problem were all self-inflicted in COVID. They went directly to consumers, bypassed their reseller channels. And that time was all B2C. I'll sell it on my website. When they bypassed all those resellers, the companies like Deck, Deckers, Hoka shoes, the companies like On, companies like, I think the Allbirds, or these some new shoe companies, they went and captured that shelf space on those retailers. Now the e-commerce strategy faltered, and now they have to re-establish all the relationships with all those retail channels, right? So Nikes were all self-inflicted wound, you know. So I have no sympathy for Nike, but now they got a new CEO who has been a veteran at Nike, probably gonna change it, but it takes time. All right, let's continue. Are investors over enthusiastic right now? So this is little scary. Tech companies with no revenue or profits are flying, and the Mag 7, etc. I mean, this is basically when you say the investors are moving towards the tail risk side, right? On the tail end of the risk off is, hey, companies like Oklo. I mean, there are some companies who don't even have a product, right? There's like a science thesis, and they are being like a lot of investors are just putting money in it because there are tailwinds, and then there's a FOMO around it. So this Nasdaq companies having no revenue, that's up like 34% for the year, whereas the Mag 7, which generates billions and billions of dollars of cash flow, is up only 18%, right? Something to be careful about, that there is a little bit of fraud, not in the overall market, but in the spaces of certain sectors of the market. So you need to play, if you're doing individual companies, which companies you want to pick up from. Okay. So here's a case for index investing, right? Someone earlier mentioned they're mostly in S&P 500. Great, right? So these are the number of stocks within S&P 500 that have outperformed on an annual basis, 2024, 152, right? So it means almost only one third of the stocks is outperformed S&P 500. So if you own individual companies, two-third, like 66% is against you. And so if you want to be an index investor, yeah, that'll be fine. And I'm perfectly okay with, if you just want to do S&P 500 and say, you know what, there is I don't know which investors have this, but you have a 3-stock portfolio, right? Index, S&P, and then some allocation to bond and some allocation to, I guess, international. That's fine too. There is no extra points for complexity in investing. I'll put it that way. You don't have to do private credit. You don't have to deploy esoteric option trades or find out, very unique company that market has not looked into it. You spend hours in researching, and then you should think that market should reward you. There is zero credit for complexity when it comes to investing. So if you can make it simple, that's fine too. Only 2% of large cap equity funds have remained in the top half over 5-year period. So this basically looks into which are the companies which were in top half in the 5-year period, and which one of them remained in top half for the next 5-year period. Right? Only 2% of large cap. So if you're doing on an index, you don't have to worry about all of the 98%. Then finally, before I jump into the AI, if you're a meme trader, now we got a meme stock ETF. And this came into on my thread because Beyond Meat was up like 700% on all that. And that's the biggest holding, was the biggest holding in this. And this ETF got launched only very recently. I think, do I have a date? Yeah, it was launched on October 8th. And then Beyond Meat was the biggest portion of this ETF. So if you have an itch to scratch, gambling itch that you want to scratch, maybe here's an ETF for you to scratch that gambling itch. Make 2% of a portfolio, make 5% of a portfolio, make sure it doesn't become big enough that when it underperforms, you're hurt. Everyone wants to have some itch that they want to scratch. So I put a couple of percent, you'll still survive. So now with ETF, you don't have to take individual companies, exposure. You can just ETF into it. All right, I see a question. How about Starbucks' Brian Nichols turning it around? Market was hopeful. Whether it's turning it around or not, only the results will tell. I have not followed Starbucks, so I don't know about its results. But I think for any business to turn around, at least give a couple of years. I think it's too early to judge. He joined last year? Maybe around just for a year or less than that. I think it's too early to judge. Give him some time. Give him 2-3 years. And if you're an investor, I mean, you should have a minimum holding period. For me, the holding period is infinite, but minimum holding period of 5 years. Otherwise, don't hold individual stocks because the businesses could, take time to turn around. Lot of leverage ETFs coming to the marketplace. Yes. Now we have a 5x leveraged applications. US, we did not have 5x. I think Europe has 5x leveraged already, EU, but US we did not have. But now I see a lot of 5x leveraged ETFs coming into picture. And why not? When the retail investors want to go out far in the risk curve, there are issuers who want to benefit from it. So they will sell you what you want and make money. Dave, if all you do is index investing, what's the strategy then? Treat it like a savings bank, just stash away regardless of up and down. Sure, fine. So here's mine. I do these things not because I want market to reward me. I wish, and market so far has rewarded me better than S&P 500, but I cannot claim that because I'm doing individual investing, because I'm spending time, I should be rewarded. Right? I do this because I love the trade. I love going through the motions of analyzing the companies. I love reading through their earnings report. I love reading about their businesses, etc. If you love the trade of investing or analysis, then do it. Just don't do it. Just don't think that because you put in that effort, market should reward you. Not gonna happen. If you don't love the trade, do index investing. Nothing wrong in that. Would have done just fine on index investing. S&P return around between 10 to 12% every year over a long period of time, including dividends, from very decent returns. Nothing wrong in that. No shame in that. I would say no shame in that. You have to love the trade of investing if you really want to get into doing individual companies. I did not do it in individual companies during my initial part of my investing because I never had time. Along with the job, it becomes really, really difficult. So all I had were ETFs. I started my investing journey with 7 ETFs, right? And then the individual companies is pretty new in my portfolios, right? It's only because then I had to find time to study these companies. But wouldn't you say your investment beat index returns? Yes, have beaten, right? But it is because the companies that I picked up have performed much better than the markets. But just because I picked up the companies doesn't entail me or entitle me to have a market beating returns just because I put in an effort, right? So you have to love the trade. Okay, let's talk about the AI stuff. Okay, but again, when say investment beating the index returns over past 5-6 years, yeah, but I guess too soon to judge. What is a 5-6 years in the decades of investing career, right? So yeah, I don't consider myself okay. I'm a better investor because maybe last 5 years I've beaten the S&P 500. 5 years is a too short period to judge. All right, let me sip some water and then we'll get into the AI stuff and then we'll look at the crypto market. Meanwhile, any other questions, anything else on your mind? All right. Yeah, I can't quit trading. It's my brother. That's right too. And I can't actually start day trading because it's not in my blood. I just can't. I just don't want to, you know, subject myself to watching 5 minute or 1 minute chart. The lowest, I would say, the precision that I have on my chart is 1 year, 1 day chart. That's what I generally I'll have it on my. This is what I see. I don't see a minute chart or anything else because that's not who I am. So you have to identify who you are and then create what works for you rather than trying to follow someone else. All right, so let's talk about AI because a lot of chatter around is in bubble, it's not in bubble, so much investments, a lot of round tripping we are seeing, vendor financing and what all stuff. What is happening in AI? I'll bring up some content that I've seen floating on the internet. You make your own decision based on your portfolio, your own individual needs, right? Even if the market, let's say, will go higher, but you may not want to take any risk because, hey, you got some expenses coming up for you which you need guarantees. You don't need probabilities. Sometimes there are some stuff for which you need guarantee. I have, for example, I have let's say I have a medical operation coming out and procedure, and I need to have $20,000 cash, which I need to pay beyond what my insurance covers. I need a guarantee that I will have $20,000. I probably will not keep it in the market, even though the probability that 2026 will be bullish, but it's a probability, not a guarantee, right? So you decide what's how you want to play with it. But let me talk about the AI stuff. A lot of stuff around the AI. The market, the media is littered with AI investment bubble inflated by tree of dilemmas. AI isn't delivering ROI. MIT study says 95% of AI projects don't deliver the AI, their ROIs. AI profit paradox. Are companies overestimating their returns? Why OpenAI may never generate ROI? So on and so forth. The investment community thinks that AI is in bubble, right? Do you think AI stocks are in bubble? In October, 54% of the investors says, yes, it is in bubble. Another argument around AI is in bubble is, oh, these AI leaders are too big. Top 10 companies during dotcom had only 34% of S&P, constitute only 34% of S&P. Now the top 10 companies have 77% of S&P 500. That's huge, very concentrated. S&P has become very concentrated, driven by a handful of companies. And now of those top 10, you got NVIDIA, Apple, Meta, Microsoft, Amazon, Tesla, Broadcom, Alphabet, which is Google. They're all AI plays. Don't say Tesla is a car company if you're a Tesla shareholder, because so far Tesla shareholders always have been saying Tesla is not a car company, it's a technology company, it's an AI company. Right now with whole humanoids and the robo taxis, AI is the play. Right? So out of top 10, majority of these companies are all AI kind of a play, tech plays, AI plays. Another question is, have they become too big? Have the valuation of stretched too far? Is there a bubble in that? CapEx is higher than dotcom and it's projected to grow. This is as a percent of US GDP. CapEx in 2000. And most of the comparisons, when you talk about the bubble in the tech side, we only had in 2000, where we had the whole tech bubble burst, right? When it comes to the current breed of fund managers, the fund managers that have seen the bubble of 1960s, the Nifty 50, like late 1960s, early 70s, those fund managers are gone. Right? They have retired. If they are still alive, they have retired. So for the current breed of money managers, the only reference around the tech bubble is the dot-com bubble. That's what we are looking at. In the dot-com, the tech CapEx was 1.4% of US GDP. Now the CapEx is 1.6%, and it is expected to grow. Oh my gosh. Are we in a bubble? Are we spending too much money? Right? Questions like vendor financing, right? Over the last, I could say, 5-6 weeks, OpenAI has announced so many deals that there have been questions around who is paying money to, right? It's like NVIDIA is paying money to OpenAI so that because they're taking stake in OpenAI so that OpenAI can buy NVIDIA chips. It's like a vendor financing, right? So it's a circular way. And they've announced similar deals with a lot of other companies. Right? The FT, I mean, these are about US now. We're talking about in FT in EU. They've been talking about CapEx end game is approaching. Why, this is maybe leading to a bubble, looking at how the previously stuff has happened, right? So here are a few cases around the bubbles. What is why AI is in bubble? AI companies are dealing among themselves. They're inflating valuations. We saw the case of OpenAI and Oracle. At OpenAI committed 300 billion for cloud compute. Oracle stock jumped higher, right? And then we don't know how the OpenAI is gonna, fund it. We don't know. And then among these deals, both the companies' valuation go higher. We don't know where the money will actually come from. Buying each other products, vendor financial sustained growth, all kind of will cause of concern. But bubble burst not because the tech is not useful. It's not that the AI is not useful, even though we have yet to see the use cases of AI, the ROI on AI. We haven't yet seen it. I mean, beyond what people like you and I will do, we haven't really, at a large scale, we haven't seen the benefits of AI, wherein the corporates margins have expanded, right? Because they started to use these AIs. Tech companies have started to use it, and we are seeing that in the layoffs, etc. But tech is only a small portion of overall economy. When will auto companies? When will the food companies, restaurants, the regular businesses start to use this AI and generate higher, better margins? We have yet to see. But sometimes the bubble bursts just because of regulatory actions, right? We could become too big, then the regulators will come in. So Europe has started the AI Act. China is restricting from its companies using Western technologies. So if we thought that Google or NVIDIA or pick whatever your favorite AI company is going to capture the whole world, maybe now we'll have a fragmented AI islands because the regulators are pitching in and saying, okay, we don't want to use NVIDIA chips. Go ahead and use Huawei chips, the recent chips, right? Competition is driving the prices down. Alibaba's Qwen, DeepSeek R3, they are much cheaper to operate. And we have seen, at least in the non-Western world, the usage of Qwen, at least in Asia, etc., is on the rise. Even I think Airbnb is using Qwen. They don't use OpenAI. They use Alibaba's Qwen models. Right? Buyers are unwilling or unable to sustain the demand. MIT reported, I mean, we already talked about it. But so far, buyers are still buying it. The exodus hasn't happened, but it's too early to judge, I would say, the success of AI projects. I mean, MIT says 95% fail. I'd say it's too early to judge. Maybe 95% fail because now it's so easy to experiment that you will just start an AI project without even thinking about the ROI, right? You don't even have to create a slide to justify to your management saying, hey, this is the ROI, let me try this stuff. Because becomes so cheaper to just try it out. And in that case, a lot of projects will fail. So maybe 95% of the have failed. It's fine. I think it's too early to judge. That's my opinion. So I'll skip this. So other side of the house, right? Where's the bubble? So not all tech investments will result in bubble. We talked about so much of a CapEx, but we have a CapEx in other technologies, and that did not result in bubbles, right? Going back from 1976s to even recently the hyperscale cloud data centers, right? Or the mobile infrastructure. Those are not bubble. So just because the CapEx spending is so high, oh my God, this must be a bubble because we are spending so much without a defined ROI or exactly knowing how the ROI would be, and hence it's a bubble. I think that's a very lame way of analysis, because not all investments have resulted in bubbles. Number two, AI is still very early in its journey, and we have a massive adoption. OpenAI, what, 800 million users? 800 million users, right? And OpenAI is so when it's OpenAI, I mean ChatGPT, it's only 3 years old. I don't know the numbers, but probably Google took, what, 7, 8 years maybe to reach at the same revenue numbers or the usage numbers. And it's only 3 years. And the usage is growing. So it's very early and the adoption is growing fast. Right? AI investment, agreed, 1.6%, or, but it's still very small part of, this is a chart from Goldman Sachs, very small part of the other investments that we have seen. Right? So it is growing, but not huge just yet. So Goldman Sachs analysts, they're like, yeah, we are not concerned. It's a huge when you look into an absolute numbers. Right? Oh my God, $400 billion of CapEx committed by these hyperscalers, a huge number. But come on, our economy has also grown. As compared to economy, yeah, not that huge. And that CapEx is manageable. I'll have some board chart around in 2000. The CapEx was almost 75% of your cash flow from operations. Right? Right now, it's only coming to 47 to 50%, less than 50%. So all these hyperscalers generate so much of a cash that they can easily fund this CapEx. Easily, if they want to. Right? So come on. It's not a big deal because the companies are different. They're generating so much of a cash. Let them spend it. Right? It's like somebody bringing $1 million in salary. Yeah, they can afford to spend 100,000 on a new car. Someone getting in 200K cannot. So these companies are different. These are like $1 million salary guys. If they want to spend whatever on the CapEx, yeah, it's a small part of their overall, cash flow from operations. I have another one wherein this basically looks at the Microsoft, Nvidia, Amazon, Alphabet, Meta, right? The cash flow from operations in the first half is around $285 billion, right? And these are their capital expenditure commitments. Right? Let's look at Microsoft. Almost $80 billion cash flow from operations over the last 2 quarters, right? So let's look at MSFT, right? Financials, operating quarters. Hopefully the numbers are right. Yeah, operating cash flow, right? Close to $80 billion. And then the commitment that they have done for CapEx in first half is $33 billion. They also do some buyback of stocks. They also have dividends. So it's only 42% of the cash flow of Microsoft is committed to CapEx. So they can still afford this CapEx and still return the dividends to the shareholders or could continue to do buyback. Max, don't do buybacks. You were doing buybacks because you were not finding a way to deploy the capital. So let's return it to shareholder. Now you found a way to deploy capital. It's only 42%. So overall, if you look at it from all these companies, 57% of the cash flow from operations is going towards CapEx commitments, right? So they can afford to spend that. And if they can afford to spend that, which was unlike dotcom, wherein majority, 3/4 of your cash flow is just going in that CapEx. This is different. Right? Now, talks about ROI. Imagine we're looking at a the question that as an investor you would ask is, you're spending so much money on CapEx, right? Would you be able to give me the return? Right? Now, we don't have an insight into when this, the manager would have gotten sign off from a CFO on doing this CapEx, what the ROI calculation they would have done for this particular project. But all we look at is overall what's their return, or at a normal level, what's the return that you would have expect from any CapEx. So like, assuming if a required rate of return is 15%, which is pretty decent required rate of return, if that's a hurdle rate for a CapEx investment, I just jump to the last row, is that then they only need to grow their cash flow by 12%. As long as Microsoft grows their cash flow by 12% or 13%, Nvidia by 2%, Amazon by 30%, they will still be able to generate 15% return on their CapEx, even after spending this huge amount of a CapEx. So I went back and looked at their cash flow, operating cash flow growth for Microsoft. Yeah, they look 12%. They have done much better historically. Same with Nvidia. Nvidia's numbers are like out of the chart. They're like a 50% cash flow growth. Google, 27%. Meta. So historically, if you look at it, and this is history, right? So we don't know whether the AI projects will have a similar amount or not, but it's not as scary the situation as you would think it would be. So from that perspective, I mean, I used to think myself, oh my God, too much AI bubble and all that stuff. But now you put these things in perspective, not that bad. These companies are amazing. Let's look at what the market signals are. PEs are elevated. Come on. Nowhere as elevated what we had for Cisco in 2000. So overall 2000, we had almost PEs were like 90x. Now we're looking at 30x, 40x S&P, the PE multiples. If you look at Nvidia, Nvidia is actually one of the cheaper ones. Nvidia became cheaper after the stock price was like up 200% because the future earnings expectations were really high. So let me go back and look at Nvidia. Right? What's Nvidia's? Nvidia is trading at a forward P of 32. Right? I don't know what's Walmart's is. Let's look at Walmart, just pulling it out. 38. So a consumer staple or retailer is trading at a higher valuation than one of the most important companies right now on the face of earth. So Nvidia is not that expensive. Right? There are many other companies which are way more expensive. Largest tech company valuations are lower than the top tech. I remember we said at like 77% in 2000. That's the comparison we have. Right. So their valuation next 12 months PE was like average was 67. Right now we're looking at average of 30. So still a lot more room to grow. Now you could question saying, oh, if they are better than the dot-com bust, that really doesn't mean it's cheap. Fair point. But that's the only comparison data point we have. So we're just trying to see how the situation was during the dot-com boom and the bust and where we are right now. IPO activity. This is generally one indicator when we have a lot of froth in the market. Dot-com, every week you will see every day you will see a couple of companies going. I mean, I wasn't in US, but when you go and look at the history, that is like 511 companies IPO'd in 2000. SPAC, we had so many SPACs coming in. We talked about it in our weekend meetings during the SPAC boom. So far, no, market hasn't boomed back. We don't. So if you look at all these previous stuff, doesn't tell me that the train is about to go off the rails. I think situation is not as bad as what you would try to infer from the headlines. If you double click it and see it, what kind of companies are there, and look at these analysis from, just don't look at only at one source, right? So when I look at it, I looked at some newspapers, I looked at some websites, I look at some fund managers. I'm just trying to collect the data so that I can make my own decision. So looking at all these, I think I'm little less bearish about all the AI stuff, saying, oh, AI is in a bubble, than what I was before. So I decided to increase my deltas in a portfolio based on but that's just me. Okay, you have to decide based on when you need cash, etc. But to me now it looks like not that frothy. But are there any signs for trouble, or what we should look out for signs of trouble? One is, in any business, if you're leveraged on the debt, that is a killer, right? Now, in this case, retail investors are leveraged, which we have seen. This is another sign of troubling sign for the retail investors. We are buying a lot of non-profitable companies, like 34% return on the non-profitable companies. Not only that, we're also levered as much as in like a dotcom and COVID peaks. So use of margin to play in the stocks, you'll do it when you're a little more, I would say, feeling riskless, little more enthusiastic about the market, lot of optimistic about the market, and the market have the most risk when everyone is feeling riskless. So I don't think this is the time to worry just yet, because retail investor is a very small portion of overall market participation, but something to look out for. Another is a debt financing by hyperscalers. So far I talked about it. I'm not concerned because you can just finance all the CapEx through your free cash flow from operations. And then, at best, if anything happens, it's your company will get impacted, not the overall economy, because you're financing from within your company's operations, right? But if you start to take on debt, and if you have in case of an Oracle, there are convertible notes. But let's say if they start to take on debt from banks, etc., that would be little concerning, because then if anything happens to these companies, it could have a much wider implications. But I don't see that yet. Now, it's only one company. I think Oracle is the only one. They have recently announced a debt financing by issuing convertible notes. So the idea is keep an eye on operation. This company, if see the debt increases proportionately, right? If it becomes too big of their overall, look at their debt to equity, make sure that in their interest, they have generated enough cash to pay off their interest. Look at the current ratio, or I forgot what's that interest expense ratio, right? As long as those are controlled, these companies generate cash. They have a predictable cash coming in. Well, they can afford it. Okay. But that would be, I would say, a couple of things that we need to keep an eye on. Not a troubling sign yet, but it could become if companies start to take a lot more debt. Meta announced a deal with Blue Owl Capital. I thought that was a debt, but I think if anything happens, it will be a Blue Owl Capital who will get impacted, right? So because they are financing, it's a joint venture in which Blue Owl Capital is putting in, I think 70%, and Meta is just putting in 30%, I guess. Beyond that, most of them are just sponsoring by their own cash flows, right? So sometimes debt is a good instrument if you want to increase your return on equities. Telecom companies have done it for years, for decades. John Malone, that was his preferred way, is to take on debt because you have a predictable stream of revenue. Why you want to dilute your equity, or but make sure you can service the debt. So I guess looking at these, they are not that big in bubble as what headlines will lead you to believe. Right? But we got to keep an eye on it, this one. Right?
Just a question. Are you buying NVIDIA at this level?
I have put spread on NVIDIA and a covered call on NVIDIA. I already own NVIDIA in my portfolio. So if the Nvidia falls down and my put spread is in the money, I'll pick some shares.
And also,
put spread alone.
That may be my general answer for most of them, because the company that I hold my portfolio, I will always have an overlay of an option trade on it. So if I like the company, if it falls down like 10%, 20%, yeah, I'll pick some.
Is that short put spread or bear put spread?
Sorry?
Short put spread?
Yeah, so on Nvidia, I have a short put spread and I have a covered call. It's all single trade. It's
Okay.
kind of call it a jade lizard, but it's not really jade lizard because the deltas are different. But it's
Vivek lizard.
yeah, you can name whatever you want to. But I mean, that's and I think Meta, I guess I have Aaron Condor, something like that. So yeah, I will always have some option trade overlaying my long portfolio.
Also, just a question. So I think a lot of the demand for AI chips from NVIDIA, I think it's built around NVIDIA's own narrative that in order to train LLMs, that you need a lot of chips, but there's a lot of Chinese models that perform on the same level, but require only a fraction of what OpenAI uses, for example. So if the whole narrative of you need a lot of chips to train the models falls apart, then I think the demand for the chips are gonna fall as well. And yeah, what do you think about that?
Yeah, but we haven't seen that yet happening. I know some of those Chinese models, they were not trained from scratch. If I recall correctly, the whole DeepSeek stuff, there was still little mystery around. They probably used the OpenAI, or was it Llama, and then distilled the learnings from there. Again, I'm not on an AI engineer, so probably won't be able to explain the details. But those were the cases. Right? The other thing is, maybe you don't. I think one thing which a lot of companies, even on the US, understand is, even if you need NVIDIA for the initial training, for inference, you probably don't need NVIDIA, right? And that's why we're seeing some deals being signed with, let's say, Google, etc., for their TPUs, and then Amazon have their own Infranium. They have that. Amazon has their Trainium chips and Infranium, what they call it as, their chips for doing their inferences. But I guess this still both. I think Amazon is still using NVIDIA, and if they can't get enough of NVIDIA chips, they use their own chips. Right? But I think it's too early to write off NVIDIA at this point of a time, despite what we are hearing from the Chinese companies. Now, when it comes to the China, right, NVIDIA is not in China, right? I mean, for I say NVIDIA is not in China, means they are not considering China into their revenue. So if there is any positive stuff happened between US and China, and then NVIDIA is allowed to sell in China, there's going to be all positive tailwind on China. And Terrell mentioned NVIDIA is not about just chips, right? Their whole CUDA ecosystem, etc., which enables you to get the maximum out of their chips, right? You might have a chips, but you may not have that software ecosystem. So that's another stuff when you look at NVIDIA. Right? And NVIDIA is not that super expensive right now as a stock. Rand says, ChatGPT is not the internet of AI, NVIDIA chips, or many other AI applications. Yeah, so if you look at NVIDIA's earning, I mean, they classify it, right? Right now, all the focus is on the data center part of revenue, the data center segment. They have a visualization, they have automotive, and then they had one more. And NVIDIA categorized their earning results into these four broad categories. Over the last 2-3 years, probably it will be there on this website, right? So over the last 2-3 years, all the focus has been on the growth on the data center, and hence the other segments are, they're not broken it down into, should be there in the metrics. Yeah, there we go. So it's data center, gaming, automotive, professional visualization. right? So a lot of focus has been around the data center because of all this AI. But if the AI cools down, there are other areas where they can pick back up. Right now, the other segments are being starved because all the chips are consumed by the AI companies. All right, anything else? Let me look at what trade I have on. Yeah, so on NVIDIA, I have a 170, 140 put spread and a covered call at 120. So where is NVIDIA right now? NVDA. Yeah, so if it goes to 100 and, sorry, not 120, 220, which is, and I think that expires on November. So it's a 21st November trade. It goes to 220. Yeah, maybe I don't mind selling a little bit of my NVIDIA. And
140 contracts or 140 strike?
No, 140, 170 strike.
Oh, okay.
Short put, and basically it's a put spread. So 170 strike, 140 strike. Put spread, and 220 is a covered call. Right?
Oh, I saw you 140 contracts. Oh,
Oh,
wow.
no. 170, 140 are the strikes. So, yeah. Microsoft, I have a iron condor. I'm just looking at some of my open trades, right? So, what do I have on a, let me look at Meta. What else I have on the Meta? Let me just see, open November. Almost 40K for premium on the November trades. So Microsoft, yeah, I have a Condor. What's that on Meta? Did I close Meta? On Mercado Libre, I have that. Hold on, let's look at Meta. And no, there's Meta. Meta again, I have Iron Condor. 870, 900, 680, 650, $30 wide Iron Condor on Meta. So 870, 900. So I have enough of a buffer on the upside, and the downside I have what, 680, 650. So $50 on the downside. So if it falls down, maybe I'll pick some Meta. As long as the business is okay, right? If I see on the Meta, when I look at the Meta's earnings results and say the business has faltered, then probably I'll not. But sometimes the market will just overreact it, right?
Well, let me ask you, right? So you talk about a business, right?
Uh-huh.
When I was asking you about Starbucks, you said, hey, it's a long-term business. You look for at least 3 to 5 years, right? From a fundamental perspective. But now when you say meta business, how long do you measure the business in this case?
So I will look at it. Let's say the stock falls down. Why did the stock fall down, right? I'll give you an example of some company which recently had it, right? Let's say Mercado Libre. The stock was punished. It was down like 10, 12%. Why? Because 2024, and I'm talking about, I think, November 2024, when they announced their Q3, November, October, that time frame, because they announced they're going to spend $3 or $5 billion of CapEx in building warehouses across Brazil, right? So when they spend that much amount of money, you know that their operating margin is going to be stressed and squeezed for the next few quarters. Market didn't like it. They punished the stock. Now, if you're an investor, you know what Mercado Libre is. It's an e-commerce company. They need to have those warehouses in place so that they can do faster delivery, cheaper delivery, which in a long term is good for the company. Maybe next 1-2 years it will squeeze the margins. So if you're a Wall Street fund manager, Wall Street analyst, you will bring down your next 1 year target and say, oh, you'll reduce whatever the ratings, etc. When I looked at Mercado Libre, I'm like, I think building warehouses is an investment that any e-commerce company should do. Amazon did the same stuff. And I think that time I did, when I put the results of Mercado Libre on Twitter, I said, you know what? I will take it as a buying opportunity. It was like at 1700 at that point of a time. So I'm like, yeah, I'll buy it. Because I think the investment that they're doing is good from a long-term business perspective. So yeah, sometimes market will give you such opportunities where the street is looking for next 12 months, but if you have a vision of your time horizon is bigger than 12 months, there are sometimes short-term pains which you need to go through it to achieve the long-term gain.
So did their earnings still keep on track when they did that, and they just cut down, or not earnings, revenue? The revenue were still good, and then they just spent money. That's why the
yeah. So let me take you to that. When I explained it, there were 3 reasons why the market punished Mercado Libre, and then I said, no, but where was it? Just give me a moment. This is August. No, it was even prior to that. September 8th, like this one. President Javier Party was handed a defeat in some local election. So the Meli was down like 5%. I'm like, that has nothing to do with the president elections. I'm like, okay, let me buy a little bit of it. So, sometimes the market will give you these opportunities. That was back. No. Oh, come on. That was, I think, last year. That's the earnings. Oh, yeah, added money here at 1,700. Okay. So this is, I think, was in November, if I recall. Yeah, November. So they reported results, and then after the results, because their EPS was down, of course, because they're spending money on it, right? And then I looked into...
So EPS was down, but revenues weren't down.
The revenues were fine, EPS were down, but there were other things also. The market got screwed because of lower margins, right? And then if you look into the details of those margins, you know exactly why the margins were down. And then, some of these things were actually right thing to do for the business in long term.
Obviously they talk about doing these spends, but did you actually double check to make sure they're not hiding stuff? You know what I mean? Like, did you actually go in the books, or you just saw that, they're spending this amount of money on these projects? That's it.
So I will go with whatever mentioned in the earnings report, right? And that much faith you need to have that manager is reporting the right numbers. If I have any concerns around irregularities in the numbers that they report, then you shouldn't be the owner of the company. So I'll give them that benefit of doubt, in which they're explaining, hey, this is what we spent and this is why we have spent, right? And other reason why their margin was down is the credit card loan. They're growing like crazy because they're entering new markets, right? And it's a high volume, low margin. So that impacts the overall margin profile also.
So you go through their earnings report and listen to the call and stuff like that. Do you ever build models or whatever, like DCF, that kind of stuff?
I just look at a reverse DCF, right? But I don't do it like every earnings call. I generally will do a reverse DCF when I'm trying to do an initial position. When I'm doing an initial analysis of a company, just look at from a valuation perspective. If it is not super expensive, I just want to check that, because good companies will always be expensive, but I just want to make sure that it's not egregiously expensive. Like, I'm not going to buy Palantir at 185. It was a great buy at $7, not at $185, right? So, yeah, so I don't do it like valuation model at every earnings side.
But you do it in the beginning.
At the beginning, I'll do it. Maybe I'll refresh it a few years down, a couple of years down the line to see if it's still okay.
Yeah.
Right. So, as long as the business continues to perform, and like I review it every quarter, right? I'll review the results and I'll bring it up for our discussion. Okay, this.
Yeah, like what's your process for checking in on these long-term holds? Just the earnings report involved?
Yeah, so I have my own filter of if any company is more than 3% of my portfolio, I will review its earnings. I'll go through its earnings call, I'll go through its earnings release document, and I'll go through its annual reports. Right? I'll put my own threshold, right? 3%, 2%, whatever you want it to be. You can do, because I can't do it for all the companies. So some companies which are like less than 1%, yeah, it's okay. It's too small.
But that's your process. Just do that. Do you look at the sector too and stuff, or do you do any analysis on the sector?
Not on the sector specific. If an individual company, then I'll just look at the company specific stuff to see is the company doing, are they doing better or not. Now, if the company is not performing, then you'll go around and say, hey, is it a company specific problem, or is it the problem that is impacting all other companies in the same sector? Because there could be some headwinds that is beyond a company, but overall economy side or a particular sector is getting impacted. In that case, I look at it.
Do you also look at like market share and users growth, that kind of stuff?
Well, yeah. I mean, whatever the standard KPIs, and at least Mercado Libre does a good job of explaining all the KPIs.
And that stuff's in the earnings report.
Sorry?
Those type of data is in the earnings report usually?
Yes, they will have their on their earnings report. So for all of these big companies, I also have what the business KPIs are. Right. So whatever you see, these things are the financial numbers. But let's say when I'm looking at a Meta, I need to look at what's the overall family, daily active users overall across the family. What's their ARPU? Yep. Is it ARPU growing or not growing? The other stuff, the business KPIs. So look at the financial KPIs as well as the business KPIs. So that will determine, what I want to do with that company.
Okay, great. Thanks.
Cool. All right. Where were we? Yeah. Okay. Maybe I'll do this next week. Fear and greed index seems to have broken, but I don't think we have time to go through it. So let's quickly go through stocks buy and sell just from I want to be transparent on my stock. So I bought a little bit of ICSH, which is basically 3-month T-bill ETF. I parked some cash. And then I initiated a new position. A new ticker in my portfolio, this is BYD Auto, which is Chinese, which is the biggest EV maker in the world. It has surpassed Tesla. And I have a funny story on BYD. First time I bought it was when I didn't even know how to even spend time on analyzing company. I bought BYD at $6 way back. I think I heard that Warren Buffett bought it. I just bought BYD at $6. And when it became $9, I sold it. Like, oh man, 50% gain. And
Kathy will just shut out of it, right? Just recently.
I don't know. So then I sold it. And that is like, I'm talking about way back, maybe 2016, 15. I don't know. When was the BYD at that time? And then I had my eye on this one, but the stock was expensive. And I think I did talk about it. Even Professor Damodaran, he had done an analysis of it. And at that time it was like here. And we looked at a price point. This was pre-split. After that, it has split now 1:6. So $80 was a price point at which may be okay to initiate a position. So now it is like close to $78 I bought it. Now I will keep an eye on it. Now I'll have to look into, it's very small position, so I don't think I'm going to go into the earnings, reviewing the earnings report, etc. But if it becomes bigger, I will start doing it. But at a high level, now I will see it, okay, what this company is doing. It is much better to buy it now than to buying it when it was 120. And then when it was on the financial media. I love to buy it when the financial media is not talking about the company.
You had a position in this from a long time ago, right? Did you get rid of it at the top?
I never had, like BYD, I had it like way back 2013, 14, I don't even know, and I sold it at 9. After that, never had BYD.
Oh, so you got rid of it when it was high?
No, I got rid of it when it was $9, and it is like 7-8 years ago.
Sure.
Because that time I did not understand myself as an investor. I'm like, made 50%, that seems to be too good. Everyone pay tuition fee. I pay tuition fee in opportunity cost. So now I'm entering back close to $70. But now the company has changed. That time I had done no analysis, just bought it because Warren Buffett bought it. All right, coming to the crypto market, we'll spend 10 minutes on it and then we'll get into the breakout rooms. Overall, nothing much. Just, having sideways movement. Bitcoin between 105 to 120 has been doing that for past 6 months. Nothing exciting to report. Just on the prices perspective, I know a lot of crypto investors or traders have been waiting for the altcoins to show up. Sorry, hasn't shown up yet. So the alt season hasn't triggered yet. Bitcoin dominance, I think, is still around 60%. So maybe it might show up a little later. But what's more important was what caught my eye was this lot of TradFis are started to embrace crypto. The biggest news of this week was JP Morgan. If you know Jamie Dimon, he's been like against crypto he made a statement that any trader dealing in crypto, he'll fire them. Any trader dealing in Bitcoin, he'll fire them. So he's been always very much against crypto. Like it's a pet rock, it's got a no value, etc. And now, this week, I think it was Thursday or maybe Friday. It was Friday. They're like, yeah, we'll allow institutional investor to borrow against their Bitcoin and Ether collateral holding. The headline doesn't tell how big this announcement is. This is JP Morgan. Now, JP Morgan is telling right now it's only for institution. Probably it'll also move into the retail. So this kind of puts a seal that these are pristine collateral, as good as a real estate. Then it becomes a part of mainstream economy. Right? So this is a huge one from the overall crypto perspective. Earlier he talked about it's a pet rock, it's a hide of fraud and all that stuff. We'll never be involved in this, but you can't ignore the money. BlackRock is making billions of dollars by their ETF and all that stuff. So slowly and steadily, all financial institutions will fall in place. So JP Morgan, welcome, Mr. Diamond. Welcome to the game. You're a few years late, but better late than never. Morgan Stanley, they had said that starting October 15th, our financial advisors are now allowed to pitch crypto funds to any clients. Vanguard, because the Vanguard has changed in the CEO, Sunil Ramji, who's a new CEO of Vanguard, was a pro-crypto guy. He came from BlackRock, where he worked on initially telling Larry Fink about getting into Bitcoin ETF. So now he's a CEO of Vanguard. So Vanguard considering maybe allowing their customers to buy Bitcoin ETF. Now this again, yesterday we have a T. Rowe Price. They are filing for crypto ETF. So see a lot of so-called traditional TradFi people now entering into this space, right? Now, BlackRock also launched Bitcoin ETF for UK retail investors. First, I got confused. I thought these guys were ahead of us. Then I realized it was the EU which was ahead of us. EU have had these Bitcoin ETPs much before US SEC approved it, and we only approved it like last year. But this was for UK. Now EU and UK are different, right? So now BlackRock has basically launched their ETPs for UK people. And why not? Because the US spot Bitcoin ETF for BlackRock has been the most profitable ETF in the history of BlackRock. So why not expand it to other geographies? Right? Other neo fintechs, Stripe, which we all know is a loved company. waiting for their IPO, right? One of the most awaited IPO for years. They post Dan Redfaced. He's one of a researcher who had also implemented the protocol in, I think, not in the recent upgrade of Ethereum, but prior to that. It's a proto-dank sharding upgrade. He was behind that. So now he has went and joined Stripe to work on their Tempo chain. Modern Treasury, a BaaS company, banking as a service company, acquired Beam, a stablecoin startup. Coinbase recently acquired, I think this week they acquired a crypto fundraising platform. So neo fintechs are, anyway, they were just waiting for regulatory clarity. Now the Trump administration is a lot more open, a lot more positive around crypto. I mean, I'm not surprised that these companies, and probably there'll be a lot more companies who are getting into crypto. In fact, I was at a startup pitch event yesterday. There was a founder coming from France. They already raised $1 million. He was talking about his own company, and again, the same stuff, using crypto rails. They were working on trying to do the synthetic stock stuff, right? So, but the more exciting stuff is all these traditional financial institutions are now open to embrace it because now we have a regulatory clarity. Mike said, did you hear news yesterday? Crypto fat finger glitch of 300 trillion. I think this is probably, it was this week. I don't think it was yesterday. This was they minted, was it Paxos? Or one of these stablecoin issuers, they minted like $300 trillion. And because someone added some more zeros, and then they have to basically burn. I don't know, did they burn? Probably they would have burnt all of that because you just can't reverse it. Yeah, but these things happen. So it was stablecoin issuer minted a lot more stablecoin than the dollar holdings or whatever the collateral asset they had. Someone fat fingered it. So then they had to burn all those assets. This is how you crash the rest of the USD financial system. Other big news is that Trump pardoned Binance CZ. Depending on which side of the Congress you are or which aisle, it could be good or a bad news. I'm not commenting either way. But this also, crypto community is pretty excited about it, saying this was a, the previous administration's, anti-crypto, and this was just like, he shouldn't have been imprisoned because it's like imprisoning president of a country because someone in their country had committed fraud and the president didn't, or murdered people, and president did not have, or the sheriff did not have enough laws or the people, police to protect it. So CZ himself wasn't involved in money laundering, but they did not have enough oversight on, or their tight AML, etc. That was a charge. So now it's been pardoned. This is after the Ross Ulbricht. He also got pardoned. So community is pretty excited about it. Solana ETF now got approved on a Hong Kong exchange this week, and if they start to trade, that gives hope to the lot of these crypto ETFs which are now knocking on the doors of SEC. We have almost 144 ETF applications waiting for SEC approval. Whenever the government reopens, we'll see. But at least on the Hong Kong exchange, they approved Solana ETF. So now, and be careful. We will see a lot of a crap coming out of this. 95% plus things will just go down to zero. There's a lot of a fraud. So buyer beware. We have a pink sheet, like we have a pink sheet stocks, we have a pump and dump. That is just multiplied in the crypto economy. So pick the projects very, very carefully, right? And now I think on Friday, they also finalized who's going to lead CFTC. Michael Slick, who is a very pro crypto and is coming from SEC. Currently, is a senior aide to SEC chairman. So over the past few years, we have a lot of concerns around, between these two regulatory bodies. There was always a fight and fight for dominance on who's going to regulate what. Hopefully, with these appointments, if we'll have a little more clarity on who's going to do what. And now we have a pro crypto guy leading the CFTC. Again, positive for the crypto side. I don't know. These are the few news. I think so far, all looks to be positive. You might wonder why the price is not moving up. Who cares, right? If you want to be in this ecosystem, right, minimum 10 years of thesis you should have. I still keep this as I've moved it out from my moonshot, a part of a portfolio. I don't think that it will go to zero, but I think it's a very high risk, high reward play. We have yet to see the real life use cases. We've yet to see anything on the real world securitizations. We have yet to see it getting integrated, even though all the signals are in the positive direction. I think it will still take a few years for it to play out. So minimum 10 years. Otherwise, there are a lot of other ways to invest. You don't have to necessarily invest in crypto, right? There are a lot of degens that get attracted because their holding period is like 2 minutes. But that's not me. All right, that's all I had for today, guys. Close to 2 hours. 12:30 is when I'll stop talking. I'm already tired, and then we get into the breakout rooms and discuss whatever you want to. Meanwhile, any other questions? I do see a couple of comments from this is how will crash the USD financial system. I mean, financial system has crashed multiple times already. Nothing new. Just that the players keep changing. Just like LTCM and GFC in 2008. So right now, actually, I had created another topic I had. Good that I didn't include in today's document is the froth. I wouldn't say froth, is the concern that I'm seeing on the private credit side. Just give hint. There are a couple of companies, unknown companies. You will know, like first brands, suppliers of automotive, like Viper blades, bulbs, and all that stuff. It declared bankruptcy, and it had caused ripples in the Wall Street. Next week topic, I'm gonna cover private credit and why, if you are investing in private credit or the companies that are in private credit, well, I gotta be careful. There are some things that we don't know, and that's what Jamie Dimon called as there are always more than one cockroaches. So next week we'll talk about those cockroaches. Aditya, anyone ever try to deconstruct and understand Nassim Taleb euro-dollar interest rate? No, that's not me. I have no idea what Taleb did. What else? I'll open the breakout rooms, and those, if you want to go and chat among yourself or on the breakout rooms, feel free. I'll be in the lobby, answer any other questions. Maybe we can discuss a few other stuff.